Today's video is about the mutual fund we are investing in. If you are investing in any kind of mutual fund or if you are planning to buy someday soon, please watch this clip to have essential information about mutual fund. I can guarantee you that you will never regret. A mutual fund is sometimes just called a fund or it's often called a unit trust in Singapore. I'll just call it a mutual fund in this clip. A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Commodity like gold, oil, or copper can also be underlying asset of a fund. Basically, you will rely on fund management company who are managing your money through their employees who are fund managers. As you know, they are high-income personnel and you will need to pay high fee to those professionals. Mutual fund is categorized as an active fund and ETF is categorized as a passive fund. I'll explain about ETF later. Once you put the money into a mutual fund, your money will be entirely controlled and managed by fund managers with their own professional judgment. Since a fund manager will actively manage your money, that's why mutual fund called as an active fund. Now, let's see how mutual fund perform on average. Since the US is the biggest stock market, let me quote a mutual fund of US consisting of large cap as a representative sample. This is the statistics showing how mutual fund performs against the return of S&P 500 by Standard & Poor's. Over 15 years, 91.6% of large cap funds underperformed S&P 500. It means only 8.4% of mutual fund beat the S&P 500 index. This is the reality of ugly mutual fund. It means if you buy 10 mutual fund, only one or less mutual fund may barely outperform the market index. In general, I can say that mutual fund cannot beat the market index. For example, if you are an investor in Singapore, whatever unit trust you buy in Singapore consisting of Singapore stocks, Straits Times index increment will be better than whatever unit trust you buy by 90% chance. In this illustration, you are the guy in the middle who is investing in a mutual fund. The guys left and right beating you are the fund management companies and brokers who sold you a mutual fund. Hope you understand the reality now. Now, let's study the fee structure of mutual fund. Once you buy mutual fund, it will only benefit the fund managers and brokers who are generally a lot richer than you. Let me explain why one by one logically and factually. In mutual fund fee structure, there are two types of fee. One is one-time fee that you pay one time. The other is a recurrent fee that you need to pay at least annually. One-time fee consists of 3% sales charge you need to pay to the distributor. Distributor is the organization or individual who sells mutual fund to you. It can be a bank, insurance company, broker, or any party. And there is a 1% redemption fee that you need to pay again whenever you withdraw and sell the fund. There is another fee called 1% switching fee. When you switch fee within the same fund management company, you will need to pay this switching fee. When you opt for the portfolio which provides you rebalancing without your knowledge, you will bear this 1% fee. Recurrent fees are even more scary as you need to pay this every year. What a loss. There is up to 2% management fee you need to pay whether your fund manager make profit or loss out of your money. Your fund manager always win the game. There is a 0.3% platform fee for a transaction platform that fund management company use. There is another 1% fee for the usage of a wrap account. There is another fee which is for a miscellaneous expense, and I assume this is 1%. But this is usually not disclosed but already incorporated for NAV, which is the net asset value of a fund. So in total, you will need to pay 5% one-time fee once you sign up to purchase a mutual fund. Then, you need to pay around 4.3% recurrent fee, which is payable by you every year. You don't see this fee on the surface, as fund profit or loss is already after calculation and deduction of all those fees. And whether you make money or your fund manager screw up the fund management and give you a significant loss, you will still need to pay this fee regardless. For example, the world's most representative stock exchange market index can be S&P 500. I have checked the performance of S&P 500 in the history. Since its inception in 1926, its annual return on average is approximately 10 to 11%. And the annual return from 1957, at the moment the stock market stabilized, average return is around 8%. Then, let me do some simulation based on the fact we have learned so far from today's video. Even though only 8.4% of mutual fund can perform like a market index, let me be so ideal and generous that you have managed to choose a mutual fund within this top 8.4%. Then on average, your mutual fund annual return should be 11% at maximum, which is the historical return of S&P 500. For example, let's say you bought a mutual fund with $10,000 and sell 1 year later. Then you are paying $300 to the distributor for a sales charge, and you will pay $100 as a redemption fee to the fund management company. You will need to pay 1% of the switching fee whenever your fund management company switch fund, but I will just assume that there will be no switching fee incurred in this simulation. Then, you will need to pay $200 to fund management company as a management fee. Then you pay another $100 for your wrap account fee. Then you give another $100 or more or less to the fund management company for their own miscellaneous expense. And you pay $30 as well for platform fee. So whether your fund manager make money or not, regardless, you will pay $830 in total as a fee out of $10,000. These are breakdowns of $830 we just check one by one. So if fund perform as a market index performance, which is 11%, your take-home profit is $10,270. So out of 11% market return, you pay 8.3% fee and take 2.3% profit only to home. So you invest your own money at your own risk just to pay the salary of your fund managers and brokers who make a lot more money than you. This is the fact. Here is a disclaimer for my calculation of the simulation I just showed you. Fund return, fee and extra is actually calculated based on NAV. NAV is the net asset value of each fund, which is a kind of balance sheet controlled by a fund management company, but I disregarded this for easy understanding and practical calculation. And return should be calculated based on an initial invested money, which already deduct sales charge, but I disregarded this as well. For example, if your fund made 10% performance and if your sales charge is 3% upfront, which will be deducted at the very beginning of your investment, $9,700 will be your initial invested money after sales charge. Then 10% return will be added to this amount of $9,700. Hence, your return will be $10,670. This is not like a $10,000 and plus 10% totaling $11,000. Actually, as I said, simulation is based on the assumption that you have managed to select a top 8.4% mutual fund that will perform like a market index. But in reality, can you choose the top 8.4% performing fund? No, you will barely select the fund which perform average if you are lucky. So once you buy a mutual fund, whatever you select, whatever you do, you are the ultimate loser. Since market always outperform whatever mutual fund you probably buy, why don't you just buy a market? This should be a common sense and the answer, I believe. Exchange trade fund is the way to just buy the entire market itself. ETF is a passive fund because it does not require any professional or subjective judgment of fund managers. ETF will just benchmark and follow the market index of any type of index you choose. Sometimes people get confused between ETF and index fund. ETF is literally different from index fund. ETF is fund that tracking indexes and trade like stock. But index fund is a fund replicating the performance of a benchmark index and trade like a mutual fund with a high expense. So index fund is kind of mutual fund with a similar fee structure like other typical mutual fund. Average expense ratio of the ETF is just 0.44%, which is extremely lower than mutual fund. You can buy market itself, which always beat performance of expensive mutual fund managers, and you even pay a very low fee compared to mutual fund. In other words, an ETF will give you a better performance than a mutual fund as it benchmark total market index, and it also charge a very low fee which will have a very positive accumulated compound effect for a long-term investment. This is why I say ETF is the answer. Frankly, I wasn't aware of ETF very well, but after I saw 2 clips from my favorite channel I subscribe, I found ETF is very attractive. However, there is a circumstance that mutual fund may be considered and can outperform an ETF. This is the clip you may refer to. Thanks for watching my video and please leave a comment for any question.